Hi, everyone. Welcome to Smarter Lending, the essential podcast for environmental, construction, and appraisal due diligence insights. My name is Liz Mahoney. As your host and the Director of Sales and Business Development at Lender Consulting Services, I bring 15 years of national lending expertise to the table. Join us as we engage with industry experts to demystify due diligence, reveal insider knowledge, and stay ahead of the trends. Whether you're in the trenches or new to the field, tune in for Smarter Lending Strategies. Let's dive in. So, Brian, why don't you give a little introduction for yourself to our audience here?
Yeah. Hi, Liz. Thank you for having me on today. Just so we're clear, these are my thoughts and not necessarily those of my colleagues at the Federal Reserve Bank of Atlanta or the Board of Governors. So I'm Brian Bailey. I've been with the Federal Reserve Bank of Atlanta as subject matter expert in commercial real estate for the last 13 years. Feels like forever. Seen, a significant amount of transition, whether it was coming out of the GFC, the great financial crisis, whether it was the corresponding 10 years of growth. Then we had COVID. Now we've had kind of the bounce back. We've had a normalization of rates. Gosh, we've just done so much. There's, lots and lots of track record and experience there. On top of that, prior to the Fed, I spent a little over 15 years in the private side of the business. I was an executive with the Big Four accounting firm Ernst & Young in their real estate advisory group. I ran real estate finance for Florida's largest commercial developer, Flagler. During the mid-2000s, we were building roughly 2 million plus square feet a year up and down the east coast of Florida, and then were purchased by Fortress Investment Group in 2007 for an astronomical amount. And then, last but not least, I spent a few years working for a family office with about $3 to $5 billion and ran acquisitions and finance for them. So I have seen a lot of real estate, and that's probably the common denominator that makes me successful at the Fed. I value almost every type of property. And so from that standpoint, I am able to backstop our examiners as they have questions on loans, as we're examining loans in the banks. I can provide information to various policymakers, whether it's Atlanta, other regional reserve banks, or whether it's even, some of the policymakers in Washington, D.C. So that's really what, has made me successful at the Fed.
Thanks, Brian. You really seen and done it all. And I've had a chance to see you in action at the MBA of New York, and I'm really excited to have you on here. So, getting started on, the current state of the economy, how would you describe the current economic conditions, particularly concerning inflation and employment trends?
Right, right. Well, I'm grateful for the opportunity to be here today. Thank you. I think, looking at the economy, economic health has been much more resilient than anyone anticipated. Certainly, the support payments coming out of the pandemic, I think, lasted longer. We had the slowing from 2021 to 2022, 2023, 2024. That slowing has, continued, but the health continues to remain positive. I think, interestingly enough, I mean, what is it, 9 out of 10 or 10 out of 10 economists in 2023 anticipated that there would be a recession that never materialized. So on that front, I think we've seen a healthy economy, but one that's gone through a significant amount of transition as we've had to pivot. Inflation has been higher, and that has created challenges for all segments of Americans. And from that standpoint, we've had to normalize rates. Rates moving up significantly have, created challenges in our area. Commercial real estate has faced some significant challenges. It's a capital intensive business, and from that standpoint, as rates have normalized, we've seen changes in value, and that's created challenges, for owners and lenders.
Yeah, we've definitely heard some of those challenges from our clients on the banking side and seen the slowdown, but thankful that it didn't end up in a full recession, as you said. Um, what impact do you see recent economic shifts having on the lending environment for banks and private lenders?
Right. And I think, we're watching it pretty closely. I think, you look at office, obviously, remote work has created some challenges from a use case. Businesses are not in the office as much. At the same point, the latest trend is they're pushing folks back to the office. I've known a few banks that in the fourth quarter, third, fourth quarter, are pushing folks back to the office. Obviously, Amazon and other large corporations are also announcing trying to get folks back to the office. So from that standpoint, I think that's good. It will be positive for the use case for office. That also overflows into other areas, i.e., ground floor retail, that lives off of the number of workers that go to work and the services that those workers need, whether it's lunch, whether it's dry cleaning, etc. So on that front, I think that flows over well. Now, I think we do have to think about the health of the consumer right now. We are seeing more delinquencies in the areas of auto loans, in credit card debt, in a number of other areas. In addition, we're seeing lower tier hotels beginning performance is beginning to erode just a hair. And from that standpoint, I think to me that signals that the consumer, or some segment of the consumer, is overextended or getting overextended. The times of heightened inflation were very challenging on some of the lower income cohorts. And from that standpoint, we've come out of that. Inflation has come down. I believe that their paychecks are growing faster than the rate of inflation. At the same point, they were in a pretty stressed period. And from that standpoint, I think some of that is carrying over into spending habits. So we will need to continue to watch that. I think, from a lender perspective, there are issues with income coming off of office. Retail continues to remain healthy. Multifamily is challenged. If you think about it, we're in a period where overall we have a shortage of housing. At the same point, for the last several years, what the industry has built has not been has there's been a mismatch between the product that's been built and that housing shortage. The industry has built a significant amount of higher end luxury apartments, and from that standpoint, the number of folks that could afford them right now is not meeting that number of apartments that's been built. So there's a mismatch there. We have an oversupply. The other area we're watching is industrial. Um, Coming off of very significant lows 2 years ago, rent growth was at rates that probably were unsustainable, meaning rent growth of double digits. Uh, just challenging for folks to keep up with. The industry has built a significant amount. We are seeing vacancy rates increase in most of the markets in the US, and those vacancy rates are highest in probably the five major industrial markets in the US. So New Jersey, Chicago, Atlanta, Dallas, and Inland Empire. And I think really that's driven because we're building these big boxes, and building them at a very healthy clip. On the other hand, I think that there is a little bit of a slowdown in the absorption. Uh, to be expected. I mean, you think about when we see an industry that takes off, like like the likes of e-commerce. From that standpoint, there's a race to procure space in this instance. And so it doesn't surprise me that at some point we'll kind of reach, a maturing phase, and that growth won't be as rapid. So maybe that's what we're beginning to see. But I saw, some press the other day where, a very large, supplier of construction materials shuttered three large distribution centers. So I think we're kind of trying to figure out some of the challenges there, and then I think there's still some issues as far as income is concerned on the expense side. I think expenses in some areas are growing faster than rents are, specifically multifamily, um, office, obviously, but property taxes, insurance, labor, all are impacting that. And those are very broad dynamics. So they're going to affect some of the specialty areas, i.e., skilled nursing, and some of those smaller segments that we're beginning to see. Some lenders report some challenges in.
Thanks, Brian. That's a great perspective of what's going on in each of the sectors. And I live in Connecticut, close to New York City, and very involved in crew New York. And I've noticed a huge change since people are starting to go back to the office. Like you said, it trickles down into hospitality and into those other areas. You get people back there and they're spending their money going out for entertainment, going to hotels, going to lunch, things like that. So it's really good to see people getting back there and spending money in those areas. So,
It's great. I mean, it's great to see, that level of engagement. I think we've missed it. I think, it is a headwind as far as networking. It is a headwind as far as learning is concerned. It's a I think we've completely underestimated the value of just the talk that goes on around the water cooler.
yeah.
For folks that are earlier in their career, they need to hear, what's being worked on, how the problems are being solved, what the culture looks like. I mean, there's so many dynamics that they're missing because they're not being exposed to that on a regular basis. Then I'm beginning to talk to, some college age folks that say, that's part of my compensation. It may not be cold hard cash, but from that standpoint, it is, networking makes me more valuable. Learning,
Or
da 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 experience makes me better, increases my market value. And so I think what you'll see some of those folks begin to go back to the office, and they are. And on that front, people who are known commodities, people who perform, it's my expectation that they will get, a lion's share of the raises, a lion's share of the promotions, bonuses, etc. And on that front, I think the people who don't go back will eventually figure out, hey, so and so got a big bonus, they got promoted, their careers, growing at a faster rate than mine. How are they doing that? Well, gosh, they're in the office all the time, so maybe I need to go from being at home to in the office. So I think there will be, some of that competitive pressure. I think there'll be, some of the recognition dynamics that will push folks back to the office.
yeah, I think for those entering the workforce, it's really valuable. I remember when I started and we were in cubicles and just hearing the conversations the people around me were having with their clients, it helped me learn just from hearing their conversation. So I think there's definitely something to be said for that.
You bet. And you think about, you talked about living in Connecticut, so New York City. You think about all the work that gets done in New York City between the
Just a
hours,
little.
the hours of 6 and 10 at night.
Yeah.
A lot of work gets done. And you think about smaller groups, we get dinner, we work and work and work. You think about it just brings the team together. It puts everybody on the same page. One of the things that we've not talked about is you think about the reduction in errors just because folks are on the same page, they're in
Yeah.
closer proximity. I'm hearing that some of the professional services firms actually have data that shows people who are in the office are performing better than folks who are working outside the office. So it's my firm belief that we will see, you know, probably not 5 days a week. We realize that there is a value for flexibility. At the same point, I think, 1 day, 2 days, no days, whatever. I think we're going to see, that number
Shift.
increase over the next 12 to 18 months.
All right. Well, let's touch a little bit on interest rates and monetary policy.
Right.
How do you think lenders and borrowers adapt to a prolonged period of elevated interest rates, or how should they?
So I think we have to change the tenor of the conversation a little bit. Yes, rates are higher. Um, but you think about it, it's more of a normalized environment. We've operated in this environment, uh, you know, many years ago, and from that standpoint, I don't, yes, it's a little bit of a shock right now because we've come out of 10 years of a 10-year period where interest rates were ultra low into one that's more normalized. But from that standpoint, I think that there are some interesting dynamics. So yes, we will have to kind of climb this hill, and try to figure out kind of what is the accurate cap rate. I think now that we've begun to see, the reduction in the inversion between long and short rates. From that standpoint, that inversion should be declining or gone. And from that standpoint, we should be able to more accurately value commercial real estate. I think that's been one of the areas that has been much more challenging there. I think, on another dynamic, I think higher rates and that uncertainty around value is giving lenders some pause. And I believe and I buy it. I mean, you think about lenders have generally been conservative in their underwriting. They didn't want to get ahead of their skis. So, from a regulated perspective, I see lots of loans, sub 65% LTV. That to me is a fairly conservative number. However, because we are uncertain of the value today, because we know that it's gone up and cap rates have gone up as well, and we're not quite 100% sure where that value is. I think we're in a time where we have more risk. And from that standpoint, with the uncertainty, with more risk, lenders are proceeding at a slower pace. And I think that is slowing the decision making process. I think, from a valuation perspective, it has to create, um, you know, some staying up at night dynamics. Hey, if this changes, if for some reason the economy shifts and rates go back up, cap rates go up again, that means I'm going to be in an area where I have even more risk. So I think lenders are being conservative right now with making decisions around lending. They're trying to get that risk profile back down to somewhere that's more conservative. They know that borrowers um, probably don't have a lot of cash to put into deals. And so, from that standpoint, I think they're taking a kind of temporary approach and saying, hey, if your loan is maturing, from that perspective, we're willing to talk if you're in good standing, but we want some cash. We want some collateral. And from that standpoint, that risk profile begins to move down. And in essence, we'll extend your loan for 12 months or maybe a couple of 12-month extensions. From that standpoint, I think we're seeing a little bit of this kind of wait and see temporary extension dynamic that's going on right now. Um, I think it certainly is a solution to getting a loan that has higher risk down into an area that's more conservative. Additionally, I think it gives time for the market to sort out, what value is. I've seen appraisals right now that run the gambit. Some of them are very, very good. Others of them are very, very challenged. And they run the spectrum of results. Uh, had a non-bank lender earlier this year say, "Hey, want you to know how bad the valuation challenge is." And I'm like, "Okay, thank God it's a non-bank lender and not a regulated one." But they had three brokers go through an office building in Miami, which in my mind is one of the stronger office markets, if not one of the strongest in the US. And in the span of 3 weeks, these three brokerage firms, which you would know, all very strong, very, very reputable firms, large reputable firms, rendered, BOVs that range from 8 million to 32 million in value. I don't know how you make a decision on
Yeah.
a project that has such a wide range of values. Um, and so we're seeing some of those right now. We're seeing some of the appraisals where I saw an appraisal a few weeks ago where the appraiser said, "Hey, this Class C office building in a major suburban metro market, uh, you know, 40, 50,000 square feet. So in the wheelhouse of just about every lender." They said, "Hey, the highest and best use is to tear it down and return it to vacant land." They did not think that, vacancy rates would surpass 30 or 35%. So from that standpoint, staying at that heightened level of vacancy, just crushes the financial characteristics of the building. So appraisers, brokers, and others, lenders, and others are challenged right now as far as the value is concerned. So on that front, I think giving it some time to let value, let those forces that are creating uncertainty and value helps lenders.
Yeah, we've definitely heard, from our clients that, the being more conservative, the slowing down, the, questioning the values, everything that you've said. And, it's been very challenging for all of them. Just everything that you mentioned is exactly what they've been telling us and asking questions on to our head of appraisal. How
And
do
you
we
think about,
how do we really value this? Can you validate that this is still true? And, coming from such a screwy economy.
right. And if you think about, an appraisal, so the drivers of value are income and then, in essence, the cap rate. So most of the uncertainty is on the cap rate because of the normalization in interest rates. We've had a healthy economy and we continue to have a healthy economy. I need to be careful. You want to be careful, just say we have a healthy economy. I think the challenge is that economy seems to be slowing a little bit. And from that standpoint, we could begin to see, some challenges around the income cash flow perspective of the building. And that could create, a dynamic where not as many borrowers are in good standing. And we have to go through, some process, special servicing, foreclosure, whatever, because the cash flow is unable to service the debt at the moment.
So, Brian, let's talk a little bit about commercial real estate and lending trends. What sectors of commercial real estate do you see as the most vulnerable to current economic conditions?
Right. Well, even though I've said good things about office, from that standpoint, I think we still have to be wary of office. From that standpoint, I continue to see buildings that were originated in a different day, where loans were originated in a different day. They were originated pre-COVID. And so, value is down 60, 70, 80%, just going to continue to remain an area that's challenged. I think also we were going through a trend of densification from that standpoint, we'd like, we want more engagement from the employees. We want the employees to be as productive as possible. We continue to try to figure out what that floor plan space look like that do that. But in essence, we have a lot more that continue to go to an open floor plan, which means we can put more people in smaller square footage. Um, that that's going to be a challenge for some of the Class C markets, probably some of the Class C assets. Additionally, I think the worker has taken the opportunity while they were at home because of COVID to move further out, to move to areas that aren't quite as costly. If they're required to go downtown, that commute now is more time intensive. It is more costly. And I think that the worker continues to remain stressed financially. And from that standpoint, we could see workers that are pushed back into the office that choose, hey, I've got to find a job in the suburbs. That will give me some time back. It will also effectively operate as a pay raise as it cuts my costs. So I think we could see some of the suburban office space perform a little bit better, and that could create some challenges for downtown office. So I'm a little bit wary of downtown office right now. I'm a little bit concerned about Class C space. Switching to multifamily. We've got a couple of years for this to kind of shake out. We are seeing the pipeline of new construction beginning to decrease, which is some good news. But we still have a significant overhang as far as high end luxury apartments with modest occupancy rates, and that's going to remain a challenge. And I think we're going to continue to see some of the foreclosures in that space. Watching industrial, so far it's good, but there's a lot of space that's coming online, and we may be getting to see a pullback in absorption. So while it's good right now, I do think we're seeing some of the warning signs there. And so it leaves me with retail to say, nothing but good things about.
We like that.
Our friends, if I had $1 for every time our friends in the press said retail apocalypse 10 or 15 years ago, I'd probably own my private island right now. But, from that standpoint, I think, a lot of lenders, a lot of developers were very wary about building and financing retail space. And we see generally a nationwide trend of very, very modest vacancy in retail. Some markets beginning to increase a little bit. So maybe the consumer is getting a little bit ahead of their skis, and we're seeing some delinquency. At the same point, retail has fundamentally changed away from being, kind of a provider, place of sale of goods and services, to one that's more focused on services. So as I am asking the friends of my college age children, hey, can you all cook? I'm getting a lot of weird stares and shaking of heads, and that may be very, very good. Very, very good omen for the likes of the takeout businesses that, they're not going to be replaced anytime soon, since a lot of this generation can't cook.
Well, I could cook very well, but different generation. I went to a recent panel discussion in New York and it was focused on New York, but talking about the retail space and how luxury stores are even buying the space themselves instead of leasing them, and that's helping a little bit. And then also that there's a lot of emphasis on the experience within those spaces. So I think that's where some of the focus has gone as well.
Absolutely. I mean, we have, technology has enhanced retailing. From that standpoint, there are, a number of dynamics but certainly all of us are walking. Most of us are walking around with phones in our hands, and we can check
Yes.
prices or hey, I like this. I don't want to carry it out of the store. We just deliver it to my home, and you know, yeah, we'll deliver it tonight before midnight.
Yeah.
I you know,
Concierge service.
yeah, some of it's gotten crazy, but it's been a very positive dynamic for retail. So I think on
Yeah.
that front, definitely some changes, but again, very susceptible to the health of the consumer. And if the consumer gets ahead of their skis, if we are seeing more delinquencies, if we begin to see paring back of certain cohorts, the spend of certain cohorts, that could very well bode some challenges for retail. I think, let's just talk about some trends outside of the four major. I think right now, any property segment that has significant exposure to labor, so it's hospitality, it's skilled nursing, it's others, right now, I mean, you think about it, there still is a shortage of workers, even though we're seeing unemployment grow modestly. The latest numbers actually ticked down, but we've seen, an upward trend over the last 12 months. From that standpoint, um, competition is real for good help. And that means the costs are going up, and that puts added pressure on the bottom line of the likes of hotels and skilled nursing and other areas that require a significant percent of labor. That is an area we need to watch. If those costs grow too much, then you're going to have to see prices grow, or you're going to have to see a cutback in service. If they're unable to get labor, you could just see, kind of like what we've seen in retail, and that people cut their hours.
Yeah. So Brian, how do you expect the current lending environment to affect the flow of capital into the commercial real estate market?
Yeah. I think it's an interesting question. So I think again, lenders were in a conservative time. They underwrote a lot of loans with the challenges of the great financial crisis in the rearview mirror. We saw lots of loans at 65%, sub 65% LTV in the regulated environment. We've seen, private equity hedge funds certainly, they get paid to take some of that risk. So they've got a different profile, a different risk profile on some of their loans that they've made. And what we know is more folks are uncertain about what value actually is. Cap rates have gone up, and those conservative LTVs, have moved upwards. Banks are trying to get more, essentially the cash in refi, in an industry that really only worked on the cash out refi for the last, I don't know, 4 decades, 3 decades. From that standpoint, that's changing the mindset. But I think, on that front, we're in a period with the normalization of rates. We're in a period where um, that risk profile on those loans is higher than folks want it to be. And so I expect that we'll continue to see a trend where lenders are trying to require some cash, some form of collateral into the deal to reduce their risk. In addition, hopefully rates, obviously long-term rates, have come down, and now they're beginning to ebb back up a little bit. But I think, as we get clarity around that, we should see more clarity around cap rates. And hopefully, from that standpoint, we begin to see them come down a little bit, which adds to the help on moving some of those loans from more risky status to one that's a little bit more conservative.
So, what other challenges do you think lenders are facing in accurately assessing the value of commercial properties in today's market?
Yeah. So unfortunately, and I'll take this away a little bit away from value, but I mean, we're seeing more fraud right now. Whether it's application fraud, there's probably a dozen cities in the US where it's more challenging to evict folks. And from that standpoint, some of those folks are working off of the spread between when they can get in an apartment and the eviction process. And really, I don't believe it's for them. I think they're positioning it as an Airbnb so that they can make some money in that period of time. I think that the multifamily operators that I've talked to are having to spend more money to try to gauge fraudulent activity on that front. So I think we see some of that. And then another form of fraud, which we've seen before, but my friends at some of the larger government agencies are talking about. You're seeing flipping between related parties to jack up the value so they can get loans that necessarily they wouldn't get initially. So I think there are, some areas of fraud which do impact value, whether it's right, directly on the value itself, or whether it's a cost which impacts operations and eventually translates to NOI, or whether it's a cost on the lender's perspective that they've got to do, you know, more oversight, a deeper dive on some of this to mitigate the fraud. So I do think we are beginning to see we have seen more of that materialize. Value wise, I think it really comes down to the reduction in the inversion between short and long term rates. I think long term rates, we saw them come down, and now we're beginning to see them go up again. Hopefully, they're not going to go terribly far, but coming down, I think created a tailwind, and that should improve uh, the ability to value property. You should see more transactions. I think in talking to lenders right now, the debt cost for industrial and a couple of the retail have come down enough where leverage has returned to positive environment. Leverage remains negative on office. It remains negative for hotels. Pardon me, for apartments. So from that standpoint, it's better to use all cash for a purchase of an apartment building or an office building because the cost of debt is higher than the rate of return. So that creates some challenges as far as value is concerned as well.
Let's talk a little bit about refinancing and maturing debt. With a significant amount of commercial real estate debt maturing soon, how do you see the refinancing landscape evolving? We were just at Crew Convention again in Vancouver, and they were talking about the $4.7 trillion question, and everything that's coming due. So, what are you thinking there?
So there's roughly 2 trillion in the next couple of years that needs to be refinanced, and a lot of that is on a very so you've seen for the last, I don't know, 12, 18 months, you've seen lenders take kind of a 12-month incremental view of lending. So they've been temporarily extending those loans as long as they can get cash in. So it continues to depend on the health of the economy and the health of the financial health of the asset, which so far continues to remain unimpaired. It remains healthy. Again, we know that some of the expenses are rising faster than rates, in a slowing environment that may be magnified. So that's an area to watch, which could create some challenges around that $2 trillion that's maturing. Um, I firmly believe that the market has the wherewithal. 2 trillion is a big number, but I firmly believe that the market has the wherewithal to refinance that amount. I think the question is, with the uncertainty around value, with some of these cash flows beginning to maybe it's not growing quite as fast. Maybe in some instances the cash flow is declining. Um, from that standpoint, that's given lenders some pause. So the other thing I'd mention is that private equity, hedge funds, those type of lenders originated, and they've got about 100 billion, give or take, that's maturing in 2024, and another 100, maybe 125 billion that's maturing in 2025. That debt, is usually has a little bit different risk profile than what you'd see out of the regulated institutions. May have a higher LTV, but it probably has a higher cost associated with it. I think that some of those lenders have pivoted, and my understanding is some of their borrowers that are looking to be refinanced are showing up at the regulated institutions' doors. So on that front, the regulated institutions are having to say, hey, this loan, we may be able to get the cost down a little bit, the rate down, but we need a significant amount of cash in the deal. So we're seeing some of those dynamics right now, and that creates some headwinds, some uncertainty around some of these deals. But I do want to say and stress that the banks are in much better financial shape. The regulated institutions are in much better financial shape than you know 15, 20 years ago.
That's good news. Brian, let's wrap things up with a little advice for the lenders and investors. What best practices would you recommend for lenders conducting due diligence in the current market environment?
Right. So things are taking longer right now. And so what I would say is as you see a loan maturing, from that standpoint, start the conversation that much sooner with the borrower, or vice versa, the borrower starts the conversation with the lender. I think, on that front, because, it's taking longer to get due diligence materials, it's taking longer to ascertain value, it's taking longer to take some of those uh, commitment, those potential commitments through committee, because the lender is just, looking at things at a much more granular detail. I think you need to start the conversation earlier.
Agreed. Brian, you come from such a wealth of knowledge and experience, and I really appreciate you bringing that to our audience today. Thank you again for joining us. And for those who are watching, stay tuned for upcoming podcast episodes on the Smarter Lending podcast. And we love having you here. Thanks for joining us.
Thank you for having me, Liz. Have a great day.
Thanks, Brian.